What's up, my fellow iguanas? Iggy here with another insightful episode on the Investing Iguana. Today, we're tackling the elephant in the room when it comes to investing in Singapore interest rates. You see, earlier we thought the US would cut rates in 2024, but that's not happening anymore. Why? Well, inflation is being stubborn and the economic data looks strong. So the US is keeping rates higher for longer. Now, this might seem like bad news, but here's the juicy part: it's actually great for Singapore's market, especially our heavy-hitting local banks. In this video, I'll explain why higher rates could be a blessing in disguise for your portfolio. Trust me, you don't want to miss this. Interest rate expectations. Interest rate expectations have shifted significantly in recent months. Initially, it was widely anticipated that the U.S. Federal Reserve would begin cutting interest rates in 2024 to combat inflation. However, that outlook has changed due to persistent inflationary pressures and robust economic data. The stubbornly high inflation rates and strong economic growth have led the Fed to maintain its hawkish stance, keeping interest rates elevated for longer than previously expected. While this might seem like a concerning development for some economies, it could actually be beneficial for Singapore's market, particularly for its formidable local banks. When interest rates remain high, it translates into higher financing and business costs for most economies, potentially hampering their growth prospects. However, Singapore's banking sector, dominated by heavyweight local players like DBS, OCBC, and UOB, is well positioned to thrive in this high interest rate environment. These local banks have the financial muscle and operational efficiency to navigate the challenges posed by elevated interest rates. In fact, higher interest rates often lead to improved profitability for banks, as they can charge more for loans while gradually adjusting deposit rates. This dynamic can boost net interest margins, a key driver of bank earnings. Moreover, Singapore's prudent regulatory framework and the robust capitalization of its local banks provide a solid foundation to weather potential economic headwinds. While some sectors may face challenges due to higher borrowing costs, the banking industry is poised to benefit from the prevailing interest rate landscape. Singapore market outlook. The outlook for Singapore's stock market has taken a positive turn, with DBS Group Research upgrading their forecast from neutral to positive. This optimistic shift is primarily driven by the anticipated performance of Singapore's local banking giants, which are poised to thrive in the current high-interest rate environment. According to DBS Group Research, the Straits Times Index, STI, Singapore's benchmark stock market index, is projected to reach an impressive 3,450 points by the end of 2024. This bullish target is underpinned by the expectation that the country's formidable local banks, often regarded as financial powerhouses, will capitalize on the prevailing high-rate landscape. In an era of elevated interest rates, banks typically benefit from improved profitability as they can charge higher rates on loans while gradually adjusting deposit rates. This dynamic can lead to an expansion in net interest margins, a crucial driver of bank earnings. Singapore's local banking behemoths, with their robust financial muscle and operational efficiency, are well positioned to navigate these favorable conditions and potentially deliver strong financial performances. Moreover, the prudent regulatory framework and robust capitalization of Singapore's local banks provide a solid foundation to weather potential economic headwinds. While some sectors may face challenges due to higher borrowing costs, the banking industry is poised to emerge as a beneficiary of the prevailing interest rate environment, further bolstering the overall market outlook. Factors contributing to the expected rise of the Straits Times Index. Earlier expectations of U.S. interest rate cuts in 2024 have been revised due to stubbornly high inflation and robust economic data. The delay in lowering rates, with rates expected to remain elevated for longer, is becoming an increasing challenge for many economies forced to follow suit with higher financing and business costs. However, this environment could actually benefit Singapore's market. With the heavy weightage of Singapore's three major banks in the Straits Times Index, the Singapore stock market is well positioned to withstand the impact of higher interest rates. DBS Group Research has upgraded their outlook for Singapore from neutral to positive, projecting the STI to reach 3,450 by year-end. Singapore stocks offer attractive attributes like relatively high dividend yields over 5% and valuations of just 12 times earnings, a discount compared to other major markets. Moreover, Singapore companies like Keppel, Singtel, and DBS have undergone restructuring to focus on new growth areas, positioning them for potential gains. Morgan Stanley has highlighted a focus list of Singapore stocks including DBS, OCBC, Singtel, Sembcorp Industries, and Hintang Singapore that could benefit from factors like high dividends, AI exposure, restructuring tailwinds, and the recovery in travel. While the higher interest rate environment poses challenges for some sectors, Singapore's banking industry is poised to thrive. Attractive attributes of Singapore stocks. Singapore stocks are presenting an enticing opportunity for investors in the current low-return environment. One of their most attractive attributes is the generous dividend yields they offer, with many companies providing yields exceeding 5%. This translates into a substantial income stream for shareholders, akin to receiving a sizable paycheck simply for holding these stocks in their portfolios. Moreover, Singapore stocks are currently trading at remarkably attractive valuations, with the overall market trading at just 12 times earnings. This valuation multiple is significantly lower compared to other major markets globally, presenting investors with the opportunity to acquire high-quality companies at what could be considered bargain prices, similar to finding a designer handbag at a garage sale. The combination of robust dividend yields and compelling valuations makes Singapore stocks an appealing investment destination, particularly for income-oriented investors seeking stable returns in a challenging market environment. With the potential for capital appreciation alongside consistent dividend payouts, these stocks offer a compelling proposition for investors looking to diversify their portfolios and tap into the growth prospects of the region. Furthermore, many Singapore companies have demonstrated resilience and adaptability, undergoing strategic restructuring initiatives to position themselves for new growth areas and evolving business models. This proactive approach not only enhances their long-term prospects but also reflects the forward-thinking mindset of the corporate landscape in Singapore. Morgan Stanley's focus list. Morgan Stanley, the renowned investment bank, has curated a focus list of Singapore stocks that they believe hold immense potential for investors. This carefully selected group comprises some of the nation's most prominent companies, including DBS, OCBC, Singtel, Sembcorp Industries, and Hintang Singapore. These stocks have garnered attention for a multitude of reasons. Firstly, they boast attractive dividend yields, offering investors a steady stream of income in addition to potential capital appreciation. Furthermore, several of these companies are well-positioned to capitalize on the burgeoning artificial intelligence (AI) trend, which has taken the tech world by storm. With AI integration becoming increasingly prevalent across various industries, these firms stand to benefit from their exposure to this cutting-edge technology. Moreover, many of the companies on Morgan Stanley's focus list have undergone strategic restructuring initiatives, streamlining their operations and positioning themselves for future growth. These restructuring efforts have the potential to unlock new avenues for profitability and enhance shareholder value in the long run. Notably, the list also includes companies poised to benefit from the resurgence of the travel and tourism industry. As the world continues to recover from the pandemic-induced slowdown, firms like Hintang Singapore, with its extensive resort and casino operations, are well-positioned to capitalize on the pent-up demand for leisure and entertainment. So there you have it, my reptilian friends. The outlook for Singapore in the second half of 2024 is looking pretty darn good, thanks to those high interest rates. Just remember, investing is a marathon, not a sprint. Stay patient, keep learning, and let that financial wisdom flow. Before you go, do me a solid and smash that like button. It really helps a small channel like mine. And if you haven't already, hit subscribe and ring that notification bell so you don't miss any of my future money-making tips. This is Iggy from the Investing Iguana, signing off. Stay green, my friends.